Okay, let's go.
If your chart looks like a neon spider web, you're not finding trading opportunities. You're tangling together random lines until the price action disappears. You cannot mark every single reversal or historical pullback and call it a key level. When you throw horizontal lines at every bump on the chart, the data becomes completely unreadable. We are going to strip all of that away. I will show you a strict, rule-based framework that relies on just one or two highly intentional lines. But first, we have to define what support and resistance actually is in this system. It is a confluence. It is an added layer of confirmation. It only works if you have already drawn your primary directional trend lines. You do not build an entire strategy around horizontal lines. Support and resistance is the finishing touch that takes a theoretical setup and turns it into a high-confidence, actionable trade. Step 1. Select your horizontal line tool and bump the thickness up to 4 pixels. You need these levels to stand out clearly against your primary trend lines. This brings us to the first guardrail, real-time proximity. Look at this graph. We want our horizontal line to anchor as close to the current active trading price as possible, snapping into place right where the action is happening. If you are drawing support on a deep valley from months ago, that data is useless for the decision you need to make right now. Keep in mind, proximity depends on your time frame. If you are a 5-minute trader, your lines need to be much closer to the current minute's action than someone trading on a 4-hour chart. Once you are close to real-time price, apply the second guardrail, maximum touch points. A touch point is simply a specific level where the price physically reacts and reverses. Think of it like a bouncy ball. The price drops, hits a solid floor, and rebounds. It hits, turns around, hits again, and turns around, bouncing off repeatedly to create distinct peaks and valleys. Grab your crosshairs tool and look at the cluster of recent data. If you nudge the line up or down by just a few ticks, you can intentionally align it to capture the maximum number of those peaks and valleys. By rigorously balancing real-time proximity with maximum touch points, you filter out the market noise. You are left with only the most statistically significant price levels. Now that we have our lines, let's solve the problem of market chop. This is the consolidation phase, where price moves sideways, chewing up your unconfirmed trades and causing frustrating back-to-back losses. To avoid this, we bracket the consolidation. This diagram shows how we draw a resistance ceiling above the sideways action and a support floor directly below it, boxing in the volatility. Next, physically set your software alerts on both of these new horizontal bumpers, as well as your primary trend line. Here is the strict rule. You do not enter a position until the price physically breaks through both the trend line and the horizontal bumper. A trend line break alone might just hit resistance and bounce back down into the box. But when the price surges violently through both the angled trend line and the horizontal line simultaneously, you have your double confirmation. The market has definitively chosen a direction. Demanding this double confirmation is your primary defense mechanism. It keeps you out of false breakouts and protects your account from getting chopped to zero. These horizontal lines also provide a framework for defining an early exit target. Once you are in a position, look directly in the path of your active trade. Apply the same 2 guardrails, real-time proximity and maximum touch points, to find the very next relevant level. You use this tactic when you want to secure a quick win, close out your position before weekend volatility hits, or intentionally break a losing streak by putting a guaranteed profit in your pocket. There is one crucial warning here. Look at this setup. You can use support and resistance for your target, but you must never use a horizontal line to place your stop-loss order. Your stop-loss must remain dynamic. Notice how the risk trails securely behind the slope of the opposing trend line, continuously sliding forward as the trade progresses, rather than resting flat. Your angled trend lines dictate the flow of the market, but when you need absolute certainty over maximum potential profit, your support and resistance lines provide a rigid, predictable exit dorm. Review your workspace now. On the left is the chaotic mess most beginners start with. On the right is the stark contrast of an intentional setup. Just 2 thick, prominent horizontal lines framing the exact data you need. You now know how to leverage these bumpers for double confirmation entries and how to target them for precise early exits. By limiting your lines and following strict placement guidelines, you have successfully replaced emotional guesswork with intentional, rule-based price action. Your next step is practical application. Spend the next 10 minutes actively backtesting the proximity and touchpoint guardrails on your preferred time frame. Applying this confluence strategy is the dividing line. It separates the traders who react to random chart movements from those who execute a consistent, repeatable plan.